Now, I've mentioned your full retirement age. My full retirement age is 66 because I was born in 1954. That was the last birth year where 66 was the full retirement age. If you're younger than I am, find your birth year on this table and it will tell you what your full retirement age is. And if you were born in 1960 or later, your full retirement age is 67. Now, people who were born in 1955 reached their full retirement age this year in 2021. And for the first time in quite a while, that full retirement age is higher. It is now 66 and 2 months. Now, anyone can choose to collect their Social Security benefits as early as 62, but depending on your birth year, that reduction could be 25% or as much as 30%. So it means people born in 1960 or later have to think long and hard claiming benefits as early as possible at age 62, because it means they are going to take a 30% haircut in those benefits for the rest of their lives. Here's another way of looking at the importance of your initial claiming age when you file for Social Security. Let's assume your full retirement age is 66 and you are entitled to $2,000 a month in Social Security benefits at your full retirement age of 66. Now, you could claim your benefits early as 62. That's 4 years early in this example. But if you do, you are not going to get the full $2,000 a month. You would only get 75% of that. You would get $1,500 a month. Or let's say for some reason you are able to wait to claim benefits up until age 70. In that case, you would receive your full retirement age benefits plus an extra 32% because of these delayed retirement credits. You would receive $2,640 a month. And in fact, it would be more than that, because every year that you are eligible for Social Security, beginning at age 62, up until the time you actually claim those benefits as late as age 70, you are also entitled to the cost of living adjustment that was applied each year from the time you were eligible at age 62 up until the time you're age 70. Now, even if you continue to work, you don't want to wait beyond age 70 to collect Social Security benefits, because those delayed retirement credits stop at age 70. So it makes no sense to delay beyond then. And here's a really powerful example. The difference between claiming your benefits as early as possible at age 62 versus waiting as long as possible at age 70 means your Social Security benefits would increase by 76% every month for the rest of your life. That is a huge payoff. Now, that example is using someone who has a full retirement age of 66. The numbers aren't quite as persuasive when your full retirement age is 67, because yes, you could wait until age 70 to claim, but you only have 3 years between your full retirement age of 67 and age 70. So that means your maximum delayed retirement credit would only be worth 24% more than your full retirement age. And a lot of times people will say to me, well, I'm born in 1960 or later, my full retirement age is 67. Should I wait until 70 to claim my benefits? And my answer is always the same. I have no idea, because it will depend on what interest rates are like at the time. At the moment, we have been living in an almost zero interest rate environment for the last 10 years. And the government is saying, if you wait, I'll give you 8% a year for every year you wait to claim Social Security. That is a huge bonus. So depending on what interest rates are like when you claim Social Security, you can decide at that point whether it makes sense to delay. Now, there are pros and cons about delaying benefits. The pros are certainly you get a much bigger benefit for each year you're willing to postpone claiming Social Security between 62 and 70. And if you're married, I usually suggest that one spouse, preferably the one with the bigger Social Security benefit, waits until age 70 to claim, because that not only creates a maximum Social Security benefit while both spouses are alive, but when one spouse dies, and actuarially it tends to be the husband who dies first, that bigger retirement benefit then translates into a bigger survivor benefit. And then the widow, who may have received a smaller retirement benefit, could then step up to this larger survivor benefit, and her smaller benefit would go away. Now, it's not a slam dunk decision for everybody. Certainly, the decision to delay collecting Social Security benefits until later means you have less cash flow right now. And it also means you have a higher break-even age. In other words, how long do I have to live to make it worthwhile for me to decide to wait until age 70 to claim? Well, Social Security benefits are designed to be actuarially fair, which means if I choose to collect reduced benefits early at 62 or full benefits at age 66 or 67, I will receive the same amount of money over my lifetime if I live to average life expectancy, which is roughly 84 for a man and 86 for a woman. But if I live longer than average life expectancy, which frankly, half of all Americans will live longer, then it would have been a better decision for me to wait longer to claim. But when it comes to married couples, the idea of this break-even age is spread over 2 lifetimes. So in general, it makes sense for one spouse to wait until age 70 because both spouses are going to have a retirement benefit. And then when one spouse dies, the other will get the survivor benefit. Now, I want to explain a little more about these delayed retirement credits in terms of who gets them. They're called delayed retirement credits for a reason. It only applies to a worker's retirement benefit. That worker's benefit will increase by 8% per year for every year he or she postpones claiming between full retirement age and age 70. These delayed retirement credits do not apply to a spouse's benefit or do not apply to a survivor benefit. If I have no earnings record of my own, but I am entitled to a benefit as a spouse once my husband claims, my maximum spousal benefit is when I'm at full retirement age. It does not continue to grow. So it does not make sense to wait to claim my spousal benefit. Same thing with the survivor benefit. My maximum survivor benefit is if I am full retirement age when I claim it. It does not get any bigger if I wait up until age 70 to claim it. Now, there are some good reasons that you may want to claim early, particularly after this last horrible year with the COVID-19 pandemic. Many people lost their jobs. If you lost your job and you need the money, go ahead and claim your Social Security benefits. Or a lot of people were able to continue working, but because of their health situation, they were afraid to return to work. So many people chose not to go back to work and to retire early. Again, if you need the money, that's what the Social Security benefits are there for. Go ahead and claim them. In some cases, people retire early and they work part-time. If you're not making a lot of money, you may still be able to claim Social Security benefit early and continue working in a part-time capacity without losing any benefits. Or in the case of a married couple, it may make sense, particularly if one spouse is planning to delay claiming, to have the other spouse go ahead and claim benefits early, assuming he or she's not working, because there are earnings restrictions if you claim benefits early and continue to work, or to claim them at full retirement age when the earnings restrictions go away. Now, how does this earning cap work? This year in 2021, if you claim benefits before your full retirement age and you continue to work, and you make more than about $19,000 a year, you are going to lose some or all of your Social Security benefits temporarily. You would lose $1 in benefits for every $2 you earn over that limit. Once you get to your full retirement age, the Social Security Administration will recalculate your benefit to take into the account that there were some benefits you did not receive because of your excess earnings, and then they are going to add them to your future benefits in the form of larger monthly benefits. So you never really lose out on those benefits, but it can be an accounting nightmare. Generally, my rule is if you plan to keep working, it generally does not make sense to claim benefits before your full retirement age, unless your earnings are fairly minimal. Now, in the year you reach your full retirement age, in the months before you hit that milestone, there's a much higher earnings limit. It's about $50,000 this year. And once you get to your full retirement age, the earnings restrictions disappear completely. So as I said, stop. If you plan to keep working, it generally does not make sense to claim benefits early. And it's important to realize that all types of Social Security benefits, whether it's a retirement benefit on your own earnings record, a benefit as a spouse on your husband or wife's earnings record, or as a survivor, they are all subject to the same earnings restrictions. But any benefits that you lose because you earn too much before full retirement age will be restored once you reach full retirement age in the form of larger monthly benefits. Now let's review some strategies for married couples. In most cases, it makes sense for the higher earning spouse to delay claiming benefits as long as possible up until age 70. That locks in not only the maximum retirement benefit while both spouses are still alive, but it is likely going to create a maximum survivor benefit for the spouse that's left behind. Having decided that one spouse is going to wait until 70, it then may make sense for the other spouse, if she's not working, to go ahead and claim her reduced Social Security benefits. And here's a secret. Even if your Social Security retirement benefits are reduced for the rest of your life because you claim them early, it has no impact on your survivor benefit if you are at least full retirement age when you collect the survivor benefit. So there is no downside for this strategy for married couples to have one wait as long as possible and the other to claim as soon as possible if she's not working. Otherwise, she will probably want to wait until her full retirement age to claim benefits when the earnings restrictions disappear. Now, unfortunately, if you are a spouse in a situation where you have no Social Security benefit on your own earnings record, you can't get that spousal benefit until your husband claims his to trigger a spousal benefit for you. As a reminder, that spousal benefit is worth half of what his benefit is. If his benefit is $2,000 a month, your benefit is going to be $1,000 a month, assuming you are at least full retirement age at the time, less if you claim earlier. Different rules apply to divorced spouses, and I'll review those in a minute. So for some lucky people who were born on or before January 1st, 1954, that means this year they would be age 68 or older. These people have an extra claiming strategy. It's known as filing for spousal benefits only. And here is how it works. If one spouse claims Social Security benefit and the other spouse was born before 1953, that second spouse has the right to say to Social Security, don't pay me my Social Security benefits. Let my benefits continue to grow by 8% a year up until age 70. But in the meantime, because I was born before 1954, I am eligible to file a restricted claim for spousal benefits. That means pay me only as a spouse. Pay me half of my husband's full retirement age benefit while my own benefit continues to grow. Unfortunately, people born after that cutoff date of January 1st, 1954 cannot do this. They will never be able to choose which benefit to claim. People, and this includes me, because I was born in December 1954, so I can't do anything fancy. Whenever I claim Social Security, I will be paid the biggest benefit to which I'm entitled at that age, whether on my own earnings record or as a spouse. I don't get to choose. But this birthday restriction has nothing to do with survivor benefits. If I am later widowed, regardless of when I'm born, I may be able to choose to claim one type of Social Security benefit first, either retirement or survivor benefits, and switch to the other larger benefit later. And here's a reminder. We've been talking about spousal benefits while your husband is alive is worth 50% of his benefit. A survivor benefit after he dies is worth 100% of that deceased worker's benefit. And survivor benefits are also different in that they are available as early as age 60 rather than 62 for retirement benefits. But if you do claim them that early, they were reduced even further. They would only be worth 71.5% of the deceased worker's benefit at age 60 compared to 100% if you waited until your full retirement age to claim them. Now, here's that strategy I mentioned earlier. Survivors can switch benefits, and this applies to widows and widowers when they were married when their spouse died, and to eligible surviving ex-spouses. That means they were married to someone for at least 10 years before divorcing. So eligible widows, widowers, and surviving ex-spouses may be able to claim a survivor benefit. And let's assume you're entitled to your own retirement benefit, and you're now also entitled to a survivor benefit. Depending on your age and whether you've collected a benefit or not yet, to start with, you may be able to collect one type of benefit first and switch to the other later. I'm going to give you two different examples. Let's assume we have a woman who has her own retirement benefit, but it's smaller than her future survivor benefit. And let's say her husband's died and she's 62. To make it easy, let's assume she's not working. She could go ahead and claim her reduced retirement benefit at 62 on her own earnings record. And that retirement benefit will be reduced for the rest of her life. But it has no impact on her survivor benefit. As long as she waits until her full retirement age, at that point she can switch to survivor benefits and she will still be entitled to 100% of what her late husband was either collecting at the time of his death or entitled to collect when he died. Let's say he died at 68 without claiming any benefits. He would have been entitled to his full retirement age benefit. Let's assume that was 66, plus 2 years of extra delayed retirement credits. That would have been 116% of his full retirement age benefit. That is the amount his widow would be able to collect as a survivor benefit if she waited at least until her full retirement age to do that. Now let's flip the story and say we have a husband with the bigger benefit and his wife dies suddenly. And let's say he's still working. He may want to collect a survivor benefit on his late wife's earning record at his full retirement age. Even if he continues to work, those earnings restrictions go away at full retirement age, but he knows his own benefit is bigger. He will want to let his own retirement benefit to continue to grow up until age 70 and then switch to that larger amount. So I want you to remember that retirement benefits and survivor benefits are two different pots of money, And it's quite possible you may be able to collect one type of benefit first and switch to the other later, and it could be in either order, as long as the bigger benefit for the rest of your life will be the larger benefit. Now, here's another point about divorced spouses. I mentioned that in most cases, to be an eligible divorced spouse, you had to be married at least 10 years, divorced, and currently single. And that applies when you're trying to collect benefits on a living ex-spouse. But if your ex dies and you waited till at least age 60 to remarry, you can collect survivor benefits on your ex, even if you're married to someone else. And here's a reminder, a spousal benefit while he is alive is worth 50% of his full retirement age benefit. A survivor benefit is worth 100% of what he was collecting. So yes, your ex is worth twice as much dead than alive, but you probably knew that anyway. Talking a little more about divorce, the rules are complicated. To give you an idea, there are more than 2,700 rules that govern Social Security benefits. I promise not to go through all of them. A lot of those rules are exceptions, and a lot of the exceptions apply to divorced spouses. So the basic rule is you must be married at least 10 years before divorcing. Think of it this way. There has to be at least a decade between I do and I don't. If you are 1 day or 1 month short of that 10-year, you'll get nothing. So if your marriage is falling apart in years 8, 9, you may want to string out the paperwork, because 10 years is all that matters, and it counts from the day you were married to the day of your final divorce decree. Now, in general, you must be unmarried to collect a benefit on your ex. And it's going to be only if your benefit as a spouse is higher than your own retirement benefit. And I mentioned earlier, for currently married couples, if I as a spouse have no benefit of my own, but I am entitled to a Social Security benefit as a spouse, I have to wait for my husband to claim his benefit before I get that spousal benefit. Well, you can imagine in a nasty divorce situation, that might be a bit of a problem. So Congress added this exception. It said, as long as you were married at least 10 years, you are divorced and currently single, and in addition, if you have been divorced for at least 2 years, and both of you are at least 62 years old, meaning you're eligible for Social Security benefits, you may be able to collect benefits on your ex, even if your ex has not claimed his benefit. That is known as being an independently entitled spouse. Now, how much you get? The amount of your benefit is based on your age at the time of your claim and how it compares to your benefit as a spouse. If your own retirement benefit is larger than half of your ex's full retirement age benefit, you're not going to get a spousal benefit. Your Social Security will be based on your own earnings record. However, if your retirement benefit is smaller, let's say your retirement benefit is $800 a month. Your husband's full retirement age benefit is $2,000 a month. Half of that is $1,000. You're going to get the full $1,000 if you're at least full retirement age at the time. And what Social Security does technically is it gives you your $800 on your own work record, and then it tops it off with that extra $200 to bring your total benefit up to the spousal amount, which is worth half of your ex's full retirement age amount. Now, for those lucky people who were born before 1954, they can take advantage of this added strategy. If they wait till their full retirement age or later, and remember, the eligible people are now turning at least 68 years old in 2021, they can say to Social Security, don't pay me my retirement benefits. Let them continue to grow 8% a year up until age 70. But in the meantime, because I was born before 1954, and because I've waited until at least my full retirement age, I want to file a restricted claim for spousal benefits. Give me half of my ex's full retirement age benefit. Now, this does not take away from any benefit he's going to receive. If he has remarried, it does not affect the benefits of his new spouse. In fact, here's a crazy scenario. Let me explain how this works. Let's assume we have a couple, John and Mary. They're married for 10 years and they get divorced, and Mary remains single. And then John marries his secretary, Susie, and they're married for 10 years and they get divorced, and Susie remains single. And John's one of those guys that doesn't like to be alone, and he goes to his local pub and he meets Tiffany. And Tiffany's 30 years old, and they fall madly in love and they get married and they have a baby, little Johnny. Little Johnny's now 2 years old and Big John drops dead. Who gets benefits? Believe it or not, everybody gets benefits. The first ex-wife, married at least 10 years, divorced, currently single, doesn't have to share. She gets 100% of John's survivor benefit. And guess what? So does the second ex-wife, Susie, who was married at least 10 years, divorced, and currently single, also gets 100% of John's survivor benefit. That's 200%. Little Johnny, his minor dependent surviving child, will get 75% of John's benefit every month until he turns 18. And Tiffany, his 32-year-old mother, will get 75% of the survivor benefit every month until little Johnny turns 16. So when you hear people talking about the long-range financial problems of Social Security, yeah, we have problems we have to deal with, but a lot of it has to do with divorce. I'm going to give you an example of this ex-spouse claiming strategy of someone who was born before 1954, who is eligible to file a restricted claim for spousal benefits. Let's say she was born in 1953, she turned 68 this year in 2021, and she has not yet claimed her Social Security benefit. Her ex-husband is also 66, and he's entitled to a Social Security benefit of $2,400 a month at his full retirement age. That's larger than her own full retirement age benefit of $2,000 a month. But because she was married at least 10 years before divorcing, is currently single, and was born before 1954, she can file a restricted claim for spousal benefits only, collect half of his benefit, that's $1,200 a month, and allow her own benefit to continue to grow up until age 70. At that point, her own benefit's going to be worth about $2,640 per month. That's 32% larger than her full retirement age amount. And that's the amount she will get for the rest of her life, unless her ex-husband predeceases her, at which point she may step up to a larger benefit if he was collecting a larger amount. And don't forget the kids. As I mentioned, if a parent dies and there's a minor dependent child under age 18, or a permanently disabled adult child, those children are eligible for survivor benefits worth 75% of the late parent's benefit. In the case of the minor child, the survivor benefits continued until they turn 18. And in the case of the permanently disabled adult child, that benefit continues for the rest of their life. Now, there is something called a family maximum limit. You can't have a dozen kids collecting on one worker's benefit. So if you have more than 2 or 3 people collecting, they'll each get a benefit, but each one may be reduced. Now, as I mentioned in the example with John, John has this minor child, Johnny. If John collects benefits, John is still alive, and he has a minor dependent child in his household, that child also gets a benefit every month until that child turns 18 or 19 if still in high school. Now, what about singles? Frankly, there's really no fancy claiming strategies available for single people. Whenever you claim your Social Security benefit, the amount you will receive is based on your average lifetime earnings and your age when you first claim them. Now, certainly you could wait up until age 70 to claim your benefits, and it would mean a larger monthly benefit for the rest of your life. But there is a potential downside for singles in choosing to delay. It's because if you die before you claim your Social Security benefit, nobody's going to get a survivor benefit. You don't have a surviving spouse. You probably don't have a surviving child. So in many cases, it may make sense for single people to wait until their full retirement age, particularly if they're still working, and then claim their Social Security benefit. Even if you don't need the money, you can stick it in the bank. And if nothing else, it will pay for your Medicare premiums, because Medicare premiums are deducted directly from your Social Security benefit. Now, guess what? This is good news. If you had to claim Social Security benefits early for whatever reason, you needed the money or you thought it was a good idea at the time and then you changed your mind, you have two do-over options. The first one is known as withdrawing your application for benefits. Anybody is entitled to withdraw their Social Security benefit application, but they must do it within the first 12 months of claiming benefits, and they can only do it once in their lifetime. And there's a catch. If you withdraw your application for benefits, you must repay any benefits you have received. Now, why would you want to do it? It's because it wipes the slate clean as if you have never claimed Social Security. So at a later date, when you're older and your benefits are worth more, you could claim them as if for the first time. If you miss that 12-month window, or if you decide you are unwilling or unable to repay the benefits you have received, now you can suspend your benefits at full retirement age or later. What does that mean? It means the benefits you have been receiving stop. But now they are going to start earning delayed retirement credits. And the good news is you don't have to pay anything back. So let's say you collected benefits early at age 62. And your full retirement age was 66. You got 75% of your full retirement age benefits for 4 years. At 66, you decided to suspend your benefits. The check stopped, but now those reduced benefits start growing. If I multiply that 75% of benefits you got at 62 times 1.32 to take into account those delayed retirement credits, that comes out to 99%. So by the time you get to 70, you would have effectively restored your full retirement age benefit. And this can be a great strategy for married couples where perhaps the bigger earner, the husband, collected benefits early because he thought it was a good idea, not realizing by collecting his own benefits early, which would be permanently reduced, could also potentially result in a smaller survivor benefit. Someone like that may want to suspend their benefits at full retirement age, have them grow, and then if he dies first, the surviving widow would get the larger amount as a survivor benefit. Here's an example that I just went through. Let's say the husband's benefit at 66 was $2,000 a month. He chose to claim early at 62 and received $1,500 a month or 75%. At 66, he suspends his benefits, the benefits stop. He earns 4 years worth of delayed retirement credits, boosting his reduced benefits to 99% of his full retirement age amount. Here's an important point for people in certain states. There's about a dozen states where public employees, people who work for the state or local governments, and in many cases, school teachers, like Texas and California, they do not pay into the Social Security system. And consequently, they're not entitled to Social Security benefits. But maybe they also work long enough in the private sector, at least 10 years, to be eligible for a Social Security benefit. They will get a Social Security benefit, but it will be reduced. There's a rule called the windfall elimination provision that says if you receive a pension based on work where you did not pay FICA payroll taxes, and you're also entitled to Social Security benefits, you will get a Social Security benefit, but it will be reduced by up to half of the amount of your pension. However, that reduction can't exceed more than about $500 a month this year. There's a separate, more onerous rule called the government pension offset provision, which applies to people who have a public pension based on work where they didn't pay FICA taxes, and they try to collect Social Security benefits as a spouse or a survivor. That rule says if you have a public pension based on work where you didn't pay FICA taxes and you try to collect Social Security as a spouse or a survivor, Social Security would first reduce that benefit by 2/3 of the amount of your public pension with no dollar limit. So for example, if your public pension was $3,000 a month, 2/3 of that is $2,000 a month. That would wipe out any spousal benefit and would significantly reduce or wipe out a survivor benefit. So I usually tell married couples in this situation where you have one spouse who is entitled to Social Security and the other one who is not, it may not make sense for the private sector worker to delay collecting benefits until 70, because the main reason you want to delay benefits till 70 is to create the largest possible survivor benefit. And if your spouse is not entitled to a survivor benefit, that delay may not be worthwhile. There are a dozen states where public employees do not participate. Those states are Alaska, California, Colorado, Connecticut, Illinois, Louisiana, Maine, Massachusetts, Missouri, Nevada, Ohio, and Texas, plus public employees in some local governments in Georgia, Kentucky, and Rhode Island also do not participate in Social Security. These offset rules may also apply to federal workers who worked under the old civil service retirement system, including postal workers. So that's the end of my presentation. I try to keep it under 1 hour because I know a lot of you are in your lunch hour and I'm very respectful of your time, but I'm going to stop sharing my screen and turn this back over to Judy, who may be able to field a few questions. However, let me add that everything I just said is available in my newly updated for 2021 ebook called Maximizing Social Security Retirement Benefits. And that is available for sale at the website maximizingsocialsecuritybenefits.com. So I'm going to turn this back over to Judy and fire away.
Mary Beth, thank you so much. And we have, of course, as you can imagine, a number of questions, but I think as they were coming in, you did answer many of them in your presentation. I do want to invite everyone on the call that you can use our Savvy Lady free financial helpline as well. And we have an entire community of certified financial advisors and planners who are happy to work with you one-on-one and answer any of your questions that really go into specific detail. And you can find that on our website. And I think I dropped it in here on the panelists. And Montana, I'm going to ask you if you could drop it in here as well. I am going to go through the questions, Mary Beth, as we have about 10 minutes until the hour. One of the first questions that came up, it was with your first slide, where you said about the 35 earning years of calculating and seeing what your highest earnings are, or what those earnings are during those 35 years. Where do you get that? And what happens if you're missing some of those years that you have said you've worked, but is not coming up on that report? Is there any remedy to find out those years? And is that an IRS sort of W-1099? Like, where do you look?
That is such a great question. Thank you for asking that. When you work each year, it's your employer's responsibility to report your earnings to both the IRS, and Social Security gets the information from the IRS. And each year you pay payroll taxes, FICA taxes on your earnings, 7.65% of your payroll, and your employer matches that. I encourage everyone attending this webinar, if you haven't done so already, go to ssa.gov, which stands for Social Security Administration.government, to set up your own personal Social Security account. That way you can get your personalized estimated benefit statement anytime, 24/7. It looks just like those statements we used to get in the mail each year a few months before our birthday. The government stopped mailing those out because it costs so much money. It is all available online. And while it's your employer's responsibility to report your earning, it's your responsibility to review it at least once a year to make sure it's accurate. And if, as the questioner said, hey, I know I made money, but it's not showing up on my earnings record, that's a big red flag because your future benefits are based on your earnings record. And you need to contact Social Security and say, there's a problem here. I had earnings in 2011 that didn't show up. Now, normally, you're supposed to report any discrepancy within about 3 years. But if you have documentation, such as old pay stubs or old tax records that verify you, in fact, had those earnings, that would be justification. So everybody's homework when you're finished this webinar is go to ssa.gov. Right on the front page, it will say, set up your My account. And that's one of the best things you can do.
Very informative, very great information. One other question here, is 3K the maximum amount you can receive from Social Security? On your graph, you showed 3K as a cap. Was just your graph, or is that the cap?
That's just an illustration for now. The maximum Social Security benefit for someone who was a high lifetime earner who earned the maximum amount each year. Right now, if they retired in 2021, their maximum benefit would be about $3,000 a month. And if they waited until age 70, it would be 32% more than that. The thing to keep in mind is we pay these FICA taxes on up to a taxable amount. This year, it's on approximately the first $148,000 of earnings. If you earn less than that, every penny that you earn is taxed for FICA purposes up to this taxable wage base. And that's what your future benefits are based on. If you earn more than that, maybe you earn $200,000 a year, your benefits are still only going to be based on the up to the taxable wage base, so that $148,000. It increases usually each year with inflation.
Here's a question also, when it's time to claim your Social Security, what is the best way to go about claiming it? Can you do it yourself, or do you have to use a CPA, or where do you go to sort of kickstart that claim?
The decision of when to claim is up to you. You do not need to go to the IRS. You can claim online. Here's another thing. Social Security offices have been closed to the public due to the pandemic since March 2020. You do not have the option at the moment of going into a Social Security office to claim your benefits. You would do this online at that same site, ssa.gov. And frankly, there are a lot of great free tools on the internet of when should I claim Social Security, where you can put in your birth date and your average earnings based on those estimated statements, or you could pay for some of these services. It's pretty nominal. There are places like socialsecuritysolutions.com and a lot of others that will help you maximize your lifetime benefits. But it's not Social Security's job to advise you when to claim. It's their job to process your application. The decision of when to claim is a very personal decision based on your own circumstances and needs.
What if you happen to have two Social Security numbers? How do you rectify that and correct that if necessary for your benefits?
You know, I've never heard of that. That's highly unusual and could create great problems. So the first thing you would do is contact Social Security and figure out how that happened and how to justify it. Because maybe there's earnings on two different numbers. If you may not get your full benefits if those earnings records are split. And frankly, it's really not legal to have two Social Security numbers. So contact Social Security to get that straightened out.
Another question, is Social Security taxable? Does it become earned income to you?
Great question. Yes, Social Security benefits are taxable once you reach a certain income threshold, and it's extremely low. Social Security benefits, when your combined income, which is everything you report on your tax return, plus half of your Social Security benefits, plus if you have any tax exempt interest from muni bonds, all that together is called combined income. And if you're single and your combined income exceeds $25,000, or if you're married and your combined income exceeds $32,000, you are going to pay income taxes on a portion of your Social Security benefits. Worst case scenario, up to 85% of your Social Security benefits can be taxed at your ordinary income tax rate. That doesn't mean you're paying an 85% tax rate. If you're in the 12% bracket, up to 85% of your Social Security benefits could be taxed at that 12% rate.
I'm going to end with this final question. And let me share with everyone who's on the call here, all of the questions that are coming in that are very personalized and specific to you. I recognize they are very, very important questions. I urge you to take those questions to our helpline, and we will match you with a volunteer pro bono to help you with those questions specifically. I did drop it in the chat, but again, it's at Savvy Ladies. Look under Savvy Programs Helpline and submit your question online, and we will match you. One final question, Mary Beth, is this is now looking into the future. They are saying that in the future that Social Security could be reduced. Does that play into the decision of when to apply for it now? Like, what is the future 10 years of Social Security look like? Will it be gone?
Right. Let me explain how Social Security is financed. Those FICA taxes that we and our employers pay are what finances Social Security benefits. It's a pay-as-you-go system. In other words, the taxes you're paying today are not going into some savings account for your future benefits. They're paying the Social Security benefits today of your parents and your grandparents. There has also been excess tax revenue that we haven't needed that has been collected over the last 30 years, and we call that the trust fund. And over the last couple years, there has not been enough benefits from FICA taxes alone to pay all the benefits. So now we're drawing down the trust funds as well. If Congress does nothing, those trust funds are supposed to run dry around 2034. And if that happened, which is very unlikely that Congress would do nothing between now and 2034, there would only be enough ongoing FICA taxes to pay about 80% of promised benefits. Now, don't panic. Social Security is the most successful and most popular federal program in history, and more than 64 million people are currently counting on their Social Security benefits. Congress knows this. They are not going to cut these benefits. Now, there may be changes going forward in the distant future in the form of how benefits are calculated, how much we pay in taxes, but traditionally, Congress never cuts benefits for existing beneficiaries or those near to retirement. I do not encourage people to claim benefits early because you're afraid the system's going broke. It's not going broke. And if you do claim early out of fear, the only thing you've guaranteed is you're going to get a smaller benefit for the rest of your life. I say make the right decision based on your future income needs, your average lifetime earnings, those benefits, and have faith in the fact that Congress must do something to fix this, and they will. The last time they did this was 1983, and to give you an idea, that was nearly 40 years ago, and the changes they made back then, including gradually changing the full retirement age, which was 65 back then, to 67, is not fully implemented yet, nearly 40 years later. That final piece of changing the full retirement age to 67 doesn't take effect till 2027. We as Americans can get used to anything as long as we are given enough time to adapt to those changes.
Well, Mary Beth, thank you so very much. If you can end and once again share your website for your book that you shared with us, I think many people, many women are interested to dive in even deeper and learn.
And I believe no one should have to read 300 pages about Social Security. This is about 50, and you can turn to the section that applies to you, married, widowed, divorced, single, married with kids, and find your solution. The website is called Maximizing socialsecuritybenefits.com. Thanks for your attention. I hope I was able to help you a little bit understanding this very important benefit that is critical to women.
Thank you so much. And thank you for all for joining us today for our Savvy Ladies webinar.